Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from U.S. regulatory updates to the OECD's latest developments. I'm Doug McHoney, PwC's International Tax Services Global Leader. The Pillar 2 engine from PwC is a game changer for Pillar 2 modeling, provision, and compliance calculations. Built on a graph system utilizing over 20 years of international tax technology, this centralized rules engine is built by a team of Pillar 2 tax experts from around the globe. PwC's Pillar 2 engine is currently available as a service and is now available to license. On this week's episode of Cross-Border Tax Talks, we're in PwC's Policy on Demand studio in Washington, D.C., where I'm excited to have Elizabeth Nelson back on the podcast. Elizabeth is an international tax partner in PwC's Washington National Tax Services practice. Elizabeth, welcome back to the podcast.
Thanks for having me. Happy to be here.
So this is a highly complex area that we're going to be going into, the dual consolidated loss rules. I've spent a lot of time over the course of our careers working on these highly complex areas. But before we dive into the DCL rules, I was spending some time navigating your various LinkedIn profiles and learned you have a Bachelor of Science in Accounting from a fellow Big 8 school, the University of Colorado. As you know, I'm a University of Missouri.
I do.
But I also noted that you have a Bachelor of Arts in French and Italian. The reason I have my accounting degree is I didn't want to take any of the foreign languages. Can you provide a little bit of insight into how one ends up with an accounting degree and a degree in French and Italian?
I love languages, and I did a study abroad 1 year in Italy right after high school with a Rotary exchange, and I lived a year in France as well on a study abroad, and I knew that I didn't want to work in academia, however, so I melded that with accounting and knowing that I wanted to do something international. So
love it. And that was kind of the bridge then to international tax.
Yes.
So I just was not a foreign language guru, to say the least. And I liked accounting because I didn't have to take foreign language. But when I was in law school, I did a backpacking trip to Europe. It was my first time out of the country. And that was my connection I like tax and I liked backpacking internationally. So I did an internship in international tax. And 30 years later, here I am. Here we are.
See, it's all connected.
So let me add one other. Do you miss the Big 8? Like I do?
I have nothing to do with sports, unfortunately, so I can't say. I'm actually even from Boulder and rarely went to football games. Sorry.
That's all right. But I do miss the Big 8, but I am excited the Missouri's in the SEC. We've got a very good football program this year. But, all right. I won't bore you with university sports. I do get a lot of questions as I travel around the globe, like, you Americans love these university sports. It is a little unique. All right. So Treasury and the IRS, Elizabeth, on August 6th, issued proposed regulations that address certain issues arising under the U.S. dual consolidated loss rules. So before we dive into some of the mechanics of these changes, for our listeners, and there are a lot of non-U.S. folks that listen to this podcast, what are the U.S. dual consolidated loss rules? And really, what are they intended to try to manage for taxpayers?
They really tended to police a double deduction, where you were taking a loss in the U.S. and you were also deducting it against income of an affiliate outside the U.S. You were getting two uses, right, in two different jurisdictions of the same loss. And it applied initially under 1503D to dual resident companies, because that pre-checked the box. That used to be how you could, be resident in two jurisdictions. And if that dual resident company was part of a consolidation in the U.S. and a foreign consolidation, if it had a loss, it was effectively getting a double deduction of that loss against affiliated income.
Yeah, for our European listeners that are familiar with the Anti-Tax Avoidance Directive 2, that it's really this double deduction. I think the Correct. U.S. was just kind of decades ahead of maybe some other territories in trying to police these rules.
Exactly.
Now we've also seen them in the context of Pillar 2 and the Transitional Safe Harbor. We'll unpack some more of that. But really, those rules were intended to prevent sort of a double deduction. there's also this concept of a foreign use. And this is going to be important as we talk about Pillar 2 and sort of how these rules apply in the context of this new global minimum taxes. What is a foreign use and why is this important for these rules?
So put simply, a foreign use, you have to meet two parameters, basically, or two requirements in order to have a foreign use. There has to be an offset under foreign law of a loss, expense, or deduction that's included in a DCL computation. And that deduction, so that's a foreign determination, right? Do you have an offset? Is it deductible under foreign law? And then the second requirement or parameter you have to meet to have a foreign use is that deduction is offsetting income that from a U.S. tax perspective is income of a foreign corporation. So for example, when the entity deducts its own loss or carries forward a loss, it's not offsetting income that is income of a foreign corporation because typically it's a check-the-box entity that's flowing into the U.S. or it's a dual resident company that is also subject to U.S. tax. It's when that loss is made available to offset another foreign corporation from a U.S. perspective's income, that's when you have the double deduction.
So the example that I used to like to give when I would teach this, and this is a complicated area, when imagine a U.S. company is investing in a U.K. entity, and it's a startup, and there's going to be losses. I'm just focusing on DCL because there are other myriad kind of provisions that apply. But if that UK company, maybe they would make a check-the-box election to treat it as a disregarded entity so that those losses would flow into the U.S. Well, you get a deduction in the UK, and that flows through. You get a deduction in the U.S. If there is another UK subsidiary somewhere else in the group, and then that loss in the UK under their loss sharing rules, if that loss is then shared against another UK CFC or UK corporation, that is a dual consolidated loss.
As long as that UK company you shared the loss with is a corporation. Corporation from a U.S. perspective, that is true.
And I think sometimes people, get confused to that. Well, the loss can be carried forward from that UK entity as long as it doesn't offset another. And when it uses the loss, when that loss is used against another, that is a foreign use. And then it triggers these DCL rules, which generally prevents the deduction or loss from being a good deduction or loss in the U.S.
Correct. You either can't take it in the year it's incurred, or if you did deduct it and there's some kind of timing difference, you could have a recapture in the U.S. of the amount you previously deducted.
All right. So if that's not complicated enough, that kind of sets the baseline for these rules. Now we've gotten some new proposed regs. And these proposed regs, let's start with the computational rules. And before we dive into Pillar 2 and some of the minimum tax, the computational rules impact the effect of intercompany transactions and then also items arising from stock ownership. So maybe we start with the intercompany transactions.
Okay. And I would just note both of those items were on the IRS Priority Business Plan, and now we have regs very short order later on both of those items. So intercompany transactions, these are actually in proposed 1502 regulations under -13. So the provision that deals with intercompany transactions.
Within a U.S. consolidated group.
Within a U.S. consolidated group. So between two C Corps, between two corporations that are members of a consolidated group. And typically under those rules, you would match the income and expense item because you're not supposed to get a benefit from transactions within a consolidated group, given those are all kind of treated almost as one taxpayer. And in certain circumstances as payments between divisions of the parent. So as almost like disregarded items. So there was a whole debate about whether for DCL purposes, things like payments on an intercompany debt between two consolidated group members should be disregarded treated as a disregarded item and not taken into account for DCL purposes because there's a special rule that does that for DCL purposes. Or whether you should respect it as a separate company transaction where you pick up the income, you pick up the expense on the other side, and then account for it under the DCL rules or what's called the matching rule. And so where the intercompany provisions ended up is that they respect the transaction as a separate company transaction between two separate members or members of the same consolidated group. And then the entity that has the DCL, if you will, so the expense, if there's a net loss in that entity, That's called the 150. They define that as a 1503D member, and you determine whether that net loss is deductible or not under the DCL rules. And that's on a special status basis. So it's almost like it's in isolation from the other members of the group and whether it's a party to an intercompany transaction. The other member, the counterparty, let's say to the debt transaction. So if you had an expense, an interest expense in the 1503D member, and you had an income inclusion in the counterparty in the group, that income inclusion and whether or not it's included is dependent on the matching rule. And so you can definitely have an outcome, and they have an example in the regulations where the interest expense in the 1503D member is disallowed under the DCL rules, so you don't deduct it, but the interest income on the other side is picked up under this matching rule. So you have a lack of parity that you would typically see in intercompany transactions.
Yeah, and so I think what's important for taxpayers to understand is, like, historically, we weren't really sure how these two different rules interacted and worked together. And particularly for the non-U.S. folks, we have a whole separate set of rules that applies for transactions that occur between consolidated group members. Where you've got separate U.S. corporations that are really treated as one consolidated group. And then how these DCL rules interact, we now have some guidance with respect to how these matching rules, how the matching rule for the or for the group for transactions within a consolidated group now apply for purposes of the dual consolidated
Correct.
rules. All right. So the other thing that we learned from a calculation perspective, and I think this is a big change, is items arising from stock ownership. So tell us about those rules.
So previously we could attribute down to a check the box entity, so hybrid entity effectively, inclusions on stock. So that could have been guilty inclusions or subpart F inclusions under our deemed inclusion regimes in the U.S. And a DRC, a dual resident company, would have, if it was the U.S. shareholder, it would have included those items. And previously, we took those into account in computing whether there was a dual consolidated loss or net income amount for those entities. So this rule would be a big change because it would exclude, really on a prospective basis, but retroactive for 2024, as we can probably talk later about the effective date. It would exclude items with respect to stock, both for dual resident companies and for separate units, so hybrid entities or a foreign branch. And so that would mean gain, loss on stock, dividends with respect to stock, deductions that relate to stock, dividend received deductions that would relate to stock as well would also be excluded. So those all would be excluded from the computation of DCL or net income for the entity.
Yeah, and I think for a number of taxpayers, after kind of guilty, after the Tax Cuts and Jobs Act and guilty that maybe had for U.S. multinationals that had a big holding company, many of them just checked the box on the holding company to treat that as a disregarded entity, and frankly probably wouldn't have spent a lot of time thinking about whether that disregarded entity could have a dual consolidated loss because it now has a big guilty inclusion, or that guilty inclusion would have been included within that particular calculation. Now we are specifically told going forward that that is not included within the DCL registry. And so companies should be more mindful to figure out, do they potentially have a dual consolidated loss? Is there stock option expense? Who knows? Any type of other expenses that could potentially be subject to these rules now that those inclusions from stock are no longer included.
Correct. The government was concerned about planning using that inclusion on stock. So this is one of the more targeted rules, I think, that they've put in there in a very broad manner. They could have made it much narrower.
Yeah, and I think a lot of these structures weren't necessarily intended to be planned, and it was just they kind of resulted from a simplicity or administrative simplicity, check the box, leave the holding company, as opposed to unwinding it. But I think taxpayers need to be very mindful if they have one of those, let's say, disregarded holding companies in their structure.
Agreed.
All right. So now let's move on to the DCL rules in the context of what they describe as foreign minimum tax regimes, which we're going to talk about as Pillar 2. And then there are also some exceptions to the application of the DCL rules in this context. Maybe we start off with some of the preamble language, because I think there was some fundamental questions of, is Pillar 2 really the same type of tax regime that should even be subject to these DCL rules? So maybe tell us a little bit about what the Treasury and IRS's position on that.
So obviously these DCL regulations very much predate any of the Pillar 2 regimes. And so foreign use, as I said, you have to have an offset under a foreign income tax law specifically in order to have one parameter of foreign use. And so the question was, obviously these Pillar 2 regimes weren't contemplated when the regs were written. Are they really foreign income tax regimes within the meaning of the foreign use provision? Because they did not previously define within the context of the DCL regulations what a foreign income tax was. So now these proposed regs do that. They include IAR and QDMTTs as foreign income taxes that would be foreign income tax regimes that would be considered when you're considering foreign use of a DCL or a DPL, as we'll talk about later. But they've basically said the government said they see no appreciable difference between these Pillar 2 regimes and regular corporate income tax regimes, and so they should be included within the meaning of foreign income taxes to be considered, including the transitional safe harbor computations, because those computations are really getting to whether then a QDMTT or IAR applies. And again, they see no appreciable difference between including a deduction in a transitional safe harbor computation or from including it in a QDMTT or IAR computation.
Yeah, so I want to come back to that because I think this is very, very interesting. So for a U.S. multinational, and it could be a same one structure too for a foreign parent group of the U.S. company with subsidiaries below. So for U.S., obviously, we're not adopting Pillar 2, at least anytime in the near future, but many U.S. multinationals operate, greater than 750 million euro revenue, operate in a jurisdiction in 2024 that has a QDMTT, or maybe they operate in a jurisdiction that what's a holding company or operating company that holds foreign subsidiaries, that it has the income inclusion rule. And what Treasury has told us is that the QDMTT, the qualified domestic minimum top-up tax, or the income inclusion rule are both foreign tax regimes that would be subject to this rule. Interestingly, they did not mention the undertax payment rule or undertax profit rule, as I prefer to call it. But it seems that Treasury also didn't talk about the UTPR in the context of the foreign tax credit either. So they're kind of parking that one to, I think, see how the dust settles on the UTPR. But yeah. QDMTTs and IRs both subject to the dual consolidated loss rules.
Correct.
Now, you mentioned the transitional safe harbor. So I want to unpack that a bit, in that many multinationals, U.S. or elsewhere, operate in higher tax jurisdictions, believe they can meet the transitional safe harbor, and so are going to be taking the simplified method, at least for the 3 years, because it is transitional. Mm-hmm. And so how does that work then if we have a particular entity, maybe we go back to the disregarded UK entity that's got a loss that has flowed in? How does this work now with the transitional safe harbor, and how could that potentially trigger a dual consolidated loss?
So basically, they do have an exception for a transitional safe harbor because they acknowledge that there is guidance putting out the duplicate loss arrangement rules apply with respect to transitional safe harbor.
In the Pillar 2 rules.
In the Pillar 2 rules. And those, and they don't apply yet for the other globe model rules, right? They only apply for transitional safe harbor. But the government effectively acknowledged that rule, which is adding back the loss then for purposes of computing if it's double deducted without any dual inclusion income to consider. So there is a clear kind of double deduction, same as the DCL rules. If that loss is added back under the duplicate loss arrangement rules for transitional safe harbor calculations, they acknowledge and have put in an exception, an example that illustrates this, that you then don't have a foreign use as long as you meet transitional safe harbor, right? So you're 15% or above. If you don't meet transitional safe harbor, that rule is not duplicated yet, right, in the model rules. And so if you fail transitional safe harbor and have to apply the model rules, you would then have a foreign use, right? And until that rule presumably gets duplicated into the model rules, and then obviously also in all the jurisdictions that are adopting these rules.
Right. So right now, the transitional safe harbor has what I have been referring to as this anti-abuse rule that is intended to prevent companies from getting a double deduction. Mm-hmm. There are other examples of that. And so you have to, what the U.S. Treasury says, well, you have to kind of layer on before you're doing your U.S. dual consolidated loss analysis, look at the transitional safe harbor rule. And if you have a double deduction that effectively gets added back for your transitional safe harbor, that is not going to be considered foreign use because effectively that loss gets kicked out of the transitional safe harbor rule.
As long as you meet transitional
safe harbor. As long as you meet the transitional safe harbor. But the OECD has also publicly said that they intend to bring in similar rules to the full globe rules, but they have not done that yet. And so your point is if you fail the transitional safe harbor, they do not have that kind of corresponding rule in the full globe rules. The OECD says that they're going to get that out before the end of the year, that we'll have those rules. And then your other point, which is a very good one, is that, well, just because the OECD gets those rules out, each implementing jurisdiction, each enacting jurisdiction has to enact those rules themselves.
Exactly.
So it is going to be a complex analysis that U.S. MNCs or companies with the U.S. will have to look at to say, okay, well, do they potentially have a transitional? Are they in the transitional safe harbor? If not, are they into the globe rules? And then if and when does the next administrative guidance kind of layer on those rules to prevent you or kick you out of the DCL rules?
Correct.
It's that easy.
Yeah, that easy.
And it's fascinating how, and again, I think the U.S. was really the first with these dual consolidated loss rules that then kind of came in with ATAD 2 in Europe. And now we've seen those kind of rules now coming into Pillar 2, which is now obviously much larger than Europe and the U.S. And now taxpayers are going to have to layer in these rules to understand where they potentially have a double deduction or where they don't.
Yeah, and I think it'll just develop similar to the DCL rules now. Have kind of morphed. The ATAD 2 rules started out as very simple double deduction rules as well, but it kind of gotten more complicated and more sophisticated as they've been revised by the different jurisdictions. So I think we'll see that also with the global rules.
Yeah, and I'm reluctant to go down this rabbit hole, but I feel like I need to ask about, there was some commentary in the preamble with respect to mere legislation and also in the context like Pillar 2, as well as the ATAD 2 rules. Why is that important for the analysis?
So mere legislation is basically the provisions that were put into the DCL rules to make sure that the U.S. FIS didn't lose out on revenue, to be honest. So they were in response, to, honestly, many, many years ago to the UK enacting a DCL-like rule for true branches. Yeah, with a decade. No, several decades.
Yeah.
And so they did not want, for example, those rules to apply in the UK to add back the loss, but then the loss was allowed in the US, and basically the US FIS lost out on the revenue, right, for the deduction, when in fact they had gotten a double. Almost they'd added back in the UK, and then they'd only gotten a deduction in the US, but the US lost the revenue. So those rules were meant to apply when you were, when the other jurisdiction had a DCL-like rule, I'm going to call it. And if they did, you can effectively then only deduct the loss under special circumstances. And so there was a question as to whether these duplicate loss arrangement rules under the safe harbor calculation was mere legislation, right?
And they're very similar to the ATAD 2 rules as well.
Exactly. And so what the government has indicated in the preamble is that they do not believe that the safe harbor duplicate loss arrangement provisions are mere legislation, that the safe harbor constitutes mere legislation. And in fact, they added pretty broadly that they do not believe that any of the ATAD 2 anti-hybrid rules are mere legislation. In fact, whenever you have a regime where you can choose to deduct it in one jurisdiction or the other, you don't have mere legislation generally.
Got it. All right, so let's move on now because I'm very excited. We have a new acronym in the game, right? Disregarded Payment Loss Rules, DPLs. So not to be confused with the dual consolidated loss. We now have a new entry in our 3-letter acronym. We love our acronyms around here.
We do.
At the CBTT. So what, Elizabeth, are the DPL rules?
So this is an entirely new regime to track disregarded payments and disregarded from a U.S. perspective, and really to police, if you will, deduction non-inclusion arrangements. And it is non-inclusion from a U.S. perspective. And so it does not really consider inclusion by a third jurisdiction. But these rules would effectively then mean that you have to take into account disregarded payments for interest equivalents, and royalties. So it is kind of limited in scope, that are, again, disregarded for U.S. tax purposes, but for which you get a deduction in the foreign jurisdiction or income inclusion in the foreign jurisdiction. There is a combination rule, so it is on a jurisdictional basis similar to DCL. And if you have the only real triggering event for this whole regime, which is computed completely separately from the DCL provisions, but leverages the architecture of the DCL provisions, the only real triggering event is a foreign use. And so if you have an aggregate net loss or disregarded payment loss in a jurisdiction, and that is put to a foreign use, then you have an income inclusion. And most notably, and this is what is taking everybody aback, it's an income inclusion that doesn't have a corresponding deduction, because you're not getting a deduction for U.S. purposes because the entire transaction is disregarded for U.S. tax purposes, but it could result under these provisions in an income inclusion in the U.S. And they don't have any statutory authority under 1503D for these provisions. And so similar to what they did for domestic reverse hybrids, to pull them into the DCL rules, they are going through the check the box regulations to get consent to be subject to the disregarded payment rules, loss rules that are part of the DCL architecture now under these proposed rules.
Yeah, and given the kind of state of play from an administrative law perspective, and I would encourage listeners to check out the podcast that I recorded with Wade, where we talked about Loper Bright and some of those other big Supreme Court decisions. It'll be interesting. It's interesting that the Treasury and the IRS have come out with this proposed reg. I think I'm very interested to see what comments look like on this particular area. But it really feels to me like that the Treasury is now really kind of policing the other jurisdictions' tax base, given to your point that there's really not a deduction in the U.S. This is really kind of the U.S. policing other types of potential interest or royalty deductions.
That's exactly right, because you don't, under this regime, you don't even count it as a disregard payment unless it is taken into account in a foreign jurisdiction under the relevant foreign tax law as either expense or income.
And it's interesting, too, to think about, well, isn't Pillar 2 intended to prevent that? Like that type of planning wasn't the anti-tax avoidance directive. There's just lots of layers of paint that I feel like on this building that were intended to do this. And here's another one. All right, so the last piece of the proposed rules was a new anti-avoidance rule to address transactions and arrangements entered into with a view to avoiding the purposes of the DCL rules. And this one I just find interesting as kind of a general anti-avoidance rule that we sometimes see in other territories. But tell us about this rule in the context of the DCL and DPL rules.
Right, because it does apply to both DCL if you have an intent to avoid both the DCL or the DPL rules. Prior to this, there wasn't really an anti-abuse rule that generally applied that was in the DCL provisions. There was what I would call a booking rule when you looked at computing DCLs or net income of a hybrid entity separate unit in terms of including or excluding items in order to avoid the rules. But it was only applied at the discretion of the commissioner. This rule, because the stated purpose for it in the preamble is that they didn't want to kind of put in place targeted rules as they saw different arrangements. They wanted a general anti-avoidance rule that could cover, multiple fact patterns where people were trying to avoid the intent of the DCL or the DPL rules by booking or not booking an item or by contributing items in, which they wouldn't normally have done from a business perspective. It just kind of covers the gamut, and it is not at the discretion of the commissioner. It's just a general anti-avoidance rule, as you said, that you see in other provisions and in other regulations that we have.
Yeah, and it'll be interesting to see is this kind of the mechanism that Treasury uses now in new regulations, kind of this, again,
Very
it feels
broad.
very broad. It feels to me like a general anti-avoidance type rule that we sometimes see in other jurisdictions outside the U.S. All right, so it's sort of and I'm not going to make you go through all these various effective dates, but because there's a whole myriad, we've got an alert that kind of goes through it, but comments are due by October 7th, and then broadly speaking, when are these rules effective, or what should taxpayers be mindful?
So I'd say the computational changes that we discussed are basically retroactive in that they apply for tax years ending on or after August 6, 2024. There's a little bit of a twist to that for the intercompany rules that I'm not going to go into that is tied to the finalization of the REGS, but otherwise the general effective date is not tied to the finalization of the reg. It will be, irrespective of whether they finalize the regs next year, for calendar year taxpayers would be applicable to 2024. There is a delayed effective date for Pillar 2 regimes being considered for an income tax regime for purposes of applying the rules. That is basically delaying it a year. And then basically the other provisions the DPL provisions have also a dual effective date. If you're in the consent rules, it's applying on or after August 6, 2024. If you're in what they call the deemed consent rules, which would apply these rules to existing structures where you're not in the check the box rules for any reason, there's a delay of effectively a year. It may be just a delay to 2025, so more like 4 or 5 months.
And I would encourage listeners to comment. Like, some of these are really big changes to our international tax system, and particularly in the context of Pillar 2. A lot of just additional compliance complexities, which is a consistent theme around here on the cross-border tax talks.
Yeah, so these DPL rules, just to say, there's a whole reporting regime just for DPLs that's similar to the DCL provisions. And so you're going to have another set of rules that you have to comply with, even if you don't have a foreign use.
Right.
And I would urge people to comment, because there's not been very many comments submitted to date. And I know there's a number of informal discussions taxpayers and advisors have had with the government, but I don't think they've gotten a lot of formal comments to date. I mean, we still have some time to go, but this is really something people need to comment on so that it can have, practical application really, and that the government understands how widely or broadly it could apply, even to fact patterns where maybe they didn't intend it to.
Yeah, it's a common theme on the podcast, trying to encourage our listeners to get involved in the process, and particularly in the U.S., the Treasury and the IRS will need to listen to those comments. Sometimes they listen more than others, but our process allows taxpayers, not just U.S. taxpayers, but any non-U.S. taxpayers that could be subject to these rules too, to be able to comment. So please participate.
Totally agree.
All right. Elizabeth, a complex area. You do a great job breaking this stuff down. Thank you very much for coming on. And then I'm guessing we're going to end up with some form of final regulations. We'll see how much what they look like compared to the proposed regs. But when those come out, we'll bring you back to the cross-border tax talks to see where things shake out.
Okay. Happy to join again.
So thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you, Elizabeth Nelson, International Tax Partner at PwC's Washington National Tax Services Practice. I'm Doug McHoney, PwC's International Tax Services Global Lead. Stay tuned for another exciting edition of the Cross-Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates, and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.